Hello, everyone, and welcome to Market Talks with me, Ray Salmond, head of markets here at Cointelegraph, where we discuss the latest in what's shaping the markets, along with valuable insights and comments from industry leaders, traders, and influencers. Today's guest is Bud White. Bud is the chief product officer and co-founder of Tacen, a US-based software company that's developing compliant software for well-regulated crypto space. Bud focuses on daily market action and prices. He also helps companies across the crypto space launch their own tokens and their own Web3 dApps. He's very passionate about solving issues in the financial system with the use of blockchain, smart contracts, and distributed ledgers. Let's look at a short video to learn a little bit more about Bud. Welcome, Bud. How are you?
Hey Ray, thanks for having me. What a great day to be with you with all the market movement.
I know it's interesting. Prices are up, but given what we went through last year, whenever I see prices up, I get a little bit apprehensive and nervous. I've gotten used to prices being down. I'm comfortable with prices being sideways. Um, like, at least there's a reason. If prices are down, you know why. You can go on Twitter, you can turn on the news, and you can find out immediately what FUD, what scam, what DeFi rug, what FTX implosion, what has Gary Gensler done to shut down something in DeFi that needed to be shut down? Like, it's really easy to find out why prices are down. But when prices are up, it's harder to determine why. And that actually makes me feel quite nervous. So, yeah, I guess we should start with that. Why
Yeah,
are prices up today, in your opinion?
yeah. Well, I mean, so the big news over the last 24 hours was the Fed releasing their interest rate hike. Um, the last interest rate hike over the last month was 50 basis points, and what they announced yesterday was another increase. Again, another increase, but this time of only 25 basis points. So I think what all the guys on Wall Street are pricing into their models right now is that the Fed thinks peak inflation has taken place and that we're seeing some um, reduction in inflation. And even though interest rates are going up, which traditionally means money will move from equities into fixed income, that the slowing down of this is the positive signal in the market that everyone's running wild with. So we've seen, because at least the tech equities I'm following, double-digit increases in price at opening bell this morning. And looking at crypto, and again, we have to remember that as a Web3 builder, I hate this, but crypto prices are pinned to tech equities right now because they're both viewed as risk assets. So when we see stock prices go up, then we see what Bitcoin's up 4% overnight, Ethereum almost 7. I'll take it, but we have to remember that it's on the back of news that there is an increase in the Fed rate, even if it's just a slowing increase in that rate.
So it's a situation where bad is good and good is bad, right? Like, bad right now, bad news is somehow good within equities markets and within crypto markets. But then, like, the good news, there is no good news really, except that price is up. But one thing that you said that I tend to agree with, like, I just bought a car and it's a collector car, so I didn't go to a dealership and get like a 2.99% APY. I didn't want to use my crypto because obviously I believe that it's going to be worth more in the future. So I took a loan from like a collector lending firm, and the interest rate is silly. Like, it's something that I definitely want to pay off fast because the interest rate is not in my favor. So seeing interest rates go up 0.25% doesn't excite me. That's going to trickle down to like my eggs and my bacon and my milk and some of my like my unfixed loans being more expensive in the short term. And like you said, tech is kind of like the canary in the coal mine for what the wider equities market may or may not do. So sure, Facebook's up today, Apple's up, all these other tech companies are up off of this assumption that inflation has been conquered, and that the interest rate hikes are going to get smaller and then eventually go away. But at the same time, in the background, for like the last 4 months, including this week, we've seen significant layoffs from high tech companies, right? And Bezos and others have come out and said, we're headed for a recession. Um, Save your money, don't go buy anything crazy. Like, these guys are saying that. Goldman Sachs and other brokerages or banks have kind of spun down their earnings expectations. And we're seeing layoffs in tech, which is a canary in the coal mine type indicator, similar to kind of like how crypto is, Bitcoin's a canary in the coal mine also for like risk assets generally, right? So what's your take on that? Like, what should we think about? Should we think that Powell has made like sufficient progress with combating and capping inflation, and that things are going to get better going into Q2, Q3, Q4? Or should we look beyond like this short-term good news and be more worried about what's around the corner?
Yeah, let's unpack that one sub question at a time. So let's try that. I mean, let's first establish why the Fed is doing what the Fed is doing. Essentially, you, me, everybody else in America has too much disposable income, right? So whether it's luxury goods or all the way down to basic necessities, travel and rent, whether it was the money that was printed during the pandemic, or a steady increase of the stock market and people's general wealth, we see inflation because people have much more capital to be able to spend on necessary and unnecessary goods. So what the Fed is trying to do is increase interest rates to make it a little bit more difficult for people to purchase everything, so that uh, prices of products don't spiral out of control because people have so much buying power. So what we're seeing right now is a bunch of layoffs with these large tech firms, right? The end goal of the Fed is to bring the overall hourly rate for a worker in the United States down, so that they have less disposable income. So they, again, to curb inflation. So we can't go to everybody in America and say, hey, will you take 20% off the top of what you're making? It doesn't really look like a continuous function like that. It's more stepwise, which is the 18,000 layoffs at Microsoft, or was it 12,000 layoffs at Amazon? So what you're seeing are a number of the operations or perhaps engineering sides of these firms that have seen pay increases over the pandemic of 50, 60, 70%. I've seen with some types of engineers and DevOps employees. We're seeing those jobs just get canned. And when they re-enter the market, they're not going to be able to get such a high salary that they had before. So what we're seeing is not a gradual decrease and everybody saying, I'll take a little bit less money so that inflation doesn't go crazy. We're seeing some of the highest paid jobs that may have increased the most over the pandemic getting wiped out, and people coming in at more reasonable wages. At least that's my take on how, I mean, obviously the reason for the layoffs isn't specifically for that point. The reason for the layoffs is when the interest rate goes up, operating capital becomes more expensive. Companies have to run more lean. So we're seeing that, but it is having the intended consequence that the Fed is looking for, which is companies lay people off, they come back at more reasonable salaries, everything gets reset. And then ideally, if it gets reset low enough that the Fed can reduce the interest rate, so you and your car loan can hopefully refi at maybe a single digit rate instead of a double digit rate, but that the problem of disposable income and savings can kind of be curtailed.
Right. So correct me if I'm wrong in this assumption. Rates get higher, capital costs and operational costs and the cost of borrowing goes up, across the corporate landscape and in consumer markets. And then layoffs occur because of high cost, capital costs, operational costs, borrowing costs. Then prices remain high, consumer demand goes down, prices eventually come down, and then the Fed can stop with all the crazy interest rates. Inflation begins to go back down to their target rate, which is 2%, which right now seems impossible. But then the knock-on effect there is that companies' earnings take a hit, stock valuations take a hit, crypto is correlated to equities markets, therefore it corrects also. So doesn't it seem a bit short-sighted to think that even if prices may have bottomed across the crypto market, that we are not yet like in a trend change or in bull market mode again? Like, it's a bit early to make that conclusion, isn't it?
I think it is a bit early. I'm not sure if you follow Michael Burry. I think everybody's following Michael Burry on Twitter these days. But he's been drawing a lot of attention to the signals we're seeing in the market right now, and not the recession we saw in 2007, 2008, but the recession that we saw in the mid 70s into the early 80s, where there were actually three cycles of inflationary period. And the way that the Fed increased rates to bring inflation down, they let off too soon. And it had this bullwhip effect where the next cycle, inflation spiked even higher than it was before. And that became an issue because I think, geez, my parents tell me stories about having savings accounts at banks that were paying 18, 19, 20% interest in the early 80s. And that was a direct result of the interest rates being played with by the Fed. So I think the question is, in the short term, right? Let's look at like the next 4 weeks. I think we're going to see a mini bull run, right? This can mean crypto goes up like it has over the last 24 hours. But what is uncertain is, from a macro perspective, are we in a 2007 recession, or are we in a 1970s recession? If it's 2007, then the Fed did what they're supposed to do, and this easing is working, and we'll be able to bring it back down to 2% inflation. Or are we doing it too soon, right? Is the Fed reducing the increase of the rates too early and not putting enough pressure on the capital markets? And will that have a bullwhip effect? So, I mean, I'm not a broker, an analyst, but I do think we're going to see rates or prices of tech equities and crypto go up over the next couple of weeks as we're all rallying around this good news, right? And at least what Wall Street analysts want you to feel is good news. But the looming question, and the one that Michael Burry is asking of people is it too soon? Because we're going to see a worse bull market. We're going to see a worse recession than what we're currently looking at if it is too early. And I mean, I don't have all the data on that, but I think that's what you need to start to think about, as maybe you're starting to take your savings and put it back into the crypto market, or taking your savings and putting it back into the equities market.
Right. Thanks for explaining that in such detail. I agree with you on the whole three-wave inflation theory, and the similarities of now to the 70s. And even my mom, like 2 weeks ago, was telling me the same thing. Like, I remember when bonds and checking accounts were paying like crazy amounts, but then mortgage rates were also really high at the same time. And she was saying, those times could come back, and how are you going to navigate that? So, okay, outside of just the short term that you've kind of explained on what you think the markets will do in the next 4 weeks or so, what are you looking forward to this year in the crypto market? How is 2023 going to differ from 2022, in your opinion?
Okay, well, I mean, the elephant in the room is FTX and Sam. What happened in November, December last year, I think, is very foundational to how we move forward as a Web3 community and a DeFi community. Um, it's become very obvious to retail investors. It's always been obvious to institutional investors, but it's become very obvious to retail investors that, like, giving custody of your digital assets to a centralized exchange has risk associated to it, right? You look at some of the biggest exchanges and they have trust licenses, right? They're regulated entities that have regulated auditing firms making sure that all of the deposits are in the accounts that they say that they're in. But what we saw with FTX, them being a US group that decided to domicile in the Bahamas, is that the accounting and the auditing isn't as robust as we once thought it was. So the reaction of the market, all of the biggest centralized exchanges in the U.S. and abroad, have been to kind of combat from a marketing standpoint how you explain to your traders, your users, that your funds are safe, right? I think you remember it must have been late November, early December. There was an article written where Vitalik and I think the CEOs of Kraken, OKX, and Coinbase said that we're going to start doing cryptographic proofs of solvency, right? Of all of our depositor funds, we're going to prove that they're in one of N wallets so that we have a continuous audit so that depositors can feel good that when they want to make a withdrawal, that there are assets there. I think there's a fundamental risk and kind of like an obvious misstep by our community to even allow centralized exchanges to be able to have custody of assets, right? If you think back to the ethos of crypto, right? Bitcoin just celebrated its 14-year anniversary, right? At the first of the year. Bitcoin is a peer-to-peer network of transferring value, unidirectional value, right? Like I can send you Bitcoin for whatever service or whatever we agree on. It was only when we wanted to do a bilateral transaction on different blockchains, right? So what's the earliest? Probably Bitcoin for Ethereum, that you had to deposit it into a centralized exchange to be able to do that bilateral transaction, because there wasn't plumbing built in the community to be able to synchronize these transactions. And we can get to solutions in a minute. But I think it was Mt. Gox was the first. People were okay depositing it in, using it as an on-ramp to get your US dollars or your fiat money into an exchange, into the ecosystem. But this whole idea of having to trust, right? We saw it with Mt. Gox, right? Whether it was a Ponzi scheme or a hack, there are many different stories happening there. In 2018 with Quadriga in Canada, we saw that in fact was a Ponzi scheme. With FTX, we're still unwinding with all of the trials that are going to take this year. But what we know for certain is that depositor funds, trader funds, were taken out of the accounts and used for lending and or personal use. So it comes down to centralized organizations are run by one or a team of people that you need to inherently trust. People aren't pricing in the counterparty risk of depositing in these centralized exchanges. And us as retail traders aren't the only ones at fault here. I've spoken to a number of institutions, funds that have not only crypto venture funds put together, but also liquid asset funds that had accounts at FTX and are still kind of sitting on their hands right now to see if those assets will ever come back. So, Ray, going back to your question, what are we going to see in 2023 with crypto? Well, I think there's a change of mindset around how you manage your crypto. So we talked about there being retail users. I like to separate retail users into two different groups, educated and uneducated, about crypto, right? You can think of, I don't have the exact numbers, but I know it's over 90% of the Coinbase users have never withdrawn their assets to a wallet. They've kept it on the exchange the entire time. Everyone who I know in the Web3 community who understands how wallets work and has like a good use of a mobile wallet or a browser-based wallet has very quickly taken all of their assets out of Coinbase, out of Kraken, out of OKX, out of Binance to put it in their own wallet. At what cost, though? Price discovery, price movements. We saw in the last 24 hours, prices go up. I know a lot of guys who have their crypto sitting in cold storage right now who have to, take it out of the closet, dust it off, connect it, do a transfer into an exchange in order to sell something that they might want to sell based on current prices. There are solutions, and one of them is what we're building at Tacen, where we offer a solution where you can keep custody of your asset and still be able to have that orders on an order book to be able to take advantage of price movements. But it's a mindset switch, right? I think the average crypto holder, not user, not Web3 individual, but the average person who's buying crypto is going to tend more towards being comfortable using a mobile wallet. Whereas 2022 and prior, they were treating it like a Robinhood, where I deposit some US dollars, it all just sits on a mobile app, and I don't really understand the technology behind it. So I think 2023 is like a reformation year for us in terms of education. I mean, I've been doing cryptography since 2009 and blockchains since 2016. So like I get it, and I sometimes I forget that like I'm not the average user of crypto anymore, right? It's become much more investment oriented rather than use case oriented in like the DeFi world or Web3 worlds. But yeah, one thing I'm very optimistic for and looking forward to us building and everybody else in our community building are solutions for people to be able to uh, take back custody, take back control of their assets, and have proper self sovereignty of wealth, which is the original dream that everyone is sold on with crypto. Is be your self sovereign nation of one, right? No one can block you from transacting. Like no one's gonna block me from sending you one ETH, right? And no government can block that as well, even though there have been instances of governments trying, like the Canadian government with the protesters in Ottawa, but let's not get into that today.
Exactly. So I like that you said 2023 will be a year of reformation. That's a good way to phrase that. Like it's been a year of reflection. It's been a year of looking at what mistakes were made, the absence of best practices, the need for transparency, and the need for like more pragmaticism to come into the space. I totally agree with you. Um, I've been doing crypto 6 years, and every time I need to go to Ledger online and connect that Nano S, whether it be through like Bluetooth or with the USB cord, and then like copy some address, put in a whole bunch of numbers, click this, and this, and then try to send it to Coinbase, which is like the only off ramp into fiat for Americans, right? Maybe there's some others, but this one's always been pretty secure. And God forbid they lose their charter, or bank license, or however, whoever's agreeing to make that conversion and off ramp, God forbid, the SEC or CFTC goes in and yanks that and removes Americans' ability to off ramp out of crypto or on ramp into it, or for institutions. But I agree, like it's very frustrating and time consuming. It takes an hour basically to move assets off of a ledger or cold wallet or Trezor onto exchange. And of course, you can do it quicker, but like you want to be careful. Sometimes you want to send a test transaction. You don't want to make any mistakes, so it is definitely not convenient to off ramp. And one thing that I was going to ask you, but I think you've kind of answered it, so we can explore a little bit more what Tacen does. But everybody wants to know, like, what might be the catalyst that brings institutional investors back into crypto markets? And how can they avoid the same risks that crippled them before, which was one, risk management, two, leverage, and three, custody. And like risk management, okay, leverage, okay, those are easy to answer. But the whole custody thing's an issue because if you're a fund, you got to set up hedges if you have like spot long positions. And setting up hedges means using a regulated exchange. And the one that we can't use is Binance. The one that investors in the previous cycle could use was FTX. And, we were led to believe that it was legit. So a lot of those institutions that you talk to that have gotten wrecked or lost their funds or customer funds had funds up there so that they could hedge, right? And that they could use those futures contracts and manage their risk. And now there's no option to do that because Coinbase doesn't have leverage or that option. So in your view, what's it going to take to bring institutional flow back into crypto? And how does maybe Tacen solve that problem?
Yeah, I'll make a quick comment on leverage because looking back to FTX, I think at their peak it was what they offered 101x leverage on certain asset classes. That's wild, right? In the traditional markets, you only ever see leverage that high on things that really, really do not move, like super unvolatile trading pairs, like currency, right? You would never see 101x even on like traditional equities, right? Like sitting on the Nasdaq, so or sitting on the New York Stock Exchange. So that was wild to begin with. because crypto is already more volatile. And to give people the tools to trade on leverage like that was basically giving people tools to go bankrupt, right? Retail, right? If you have infinite cash or a huge pile of money like institutions, sure, there's definitely the time and the place. But I think the question that you want to get to is, yeah, okay, let's say that you're a liquid assets fund and you got into Bitcoin. What's it trading at right now? 23.8. So like, let's say you got in a couple of weeks ago at like 22,000 and you've got, you want to sell when it hits 24. Okay, great. You can't have your Bitcoin sitting on a ledger, right? You have to have it deposited in an exchange with a limit order sitting there so that when it hits your target price, you can liquidate it and or have a more complex order type so you can like cascade different types of orders to meet your investment thesis or what you're comfortable with your risk tolerance. So if you're an institution that's playing in this way, your options are one, deposit assets into a centralized exchange and hope and pray that they're there when you need to withdraw them. Or two, a lot of institutions are using traditional means of trading, which is just calling up an OTC desk and getting a spot price for an asset over the phone and settling up later, either netting at end of day or netting at end of week, which has its own set of risks for counterparty insolvency. And when I learned capital markets, I learned it from some of the best that were at JP Morgan during the 2008 credit crisis. So I know a lot about counterparties going insolvent in the middle of a deal. And we've seen this in the crypto market on both sides already. We've seen trading firms and exchanges go insolvent, right? Three Arrows Capital and FTX and Voyager. So, the things I'm talking about aren't unheard of. They're things that we've seen in the last 3 months. So, doing deals on trust is not good. Depositing your institutions, right? Remember, as an institutional trader, you're beholden to other laws, right? Like coming out of 2008, there were a whole set of laws, I think the Dodd-Frank and a few others that require you to do certain things like hold capital against risky assets and all of these things so that if your counterparty defaults, that you do have enough operating capital to one, keep the lights on, and two, be able to pay back investors in certain ways. And we're not seeing that if you're depositing all of your assets into an exchange that take full custody and does whatever with it, right? All of these proof of solvency initiatives within the exchanges are good, but they still can't prove that there's an action where a bad actor internally does a huge withdrawal, or that, like with what we saw with FTX, that a loan has been made with funds that weren't allocated to be lent out. So, okay, I mean, that's kind of the state of the world. There is no good way to be an institutional trader. So, what we're trying to bring to the market with Tacen is a way for you to take your crypto, put it into a smart contract that is under your custody and your custody only, lock it in that smart contract when you put orders up on an order book. So let's take the example, right? You've got some Bitcoin, you bought it at 22 and you're trying to sell it when it hits 25. Imagine being able to have that Bitcoin in your custody at all points in time until the order gets matched as a trade, and then the lock comes off and the transaction happens. So we're allowing for these tools where we're allowing institutional and retail traders to be able to trade in the way that they want to trade, keep custody of your asset the entire time, and still be able to do complex trade types, interact with a central limit order book in the way that they would with any other asset class. The other important thing, and I think a lot of the educated viewers here are saying, well, why can't you do that on a DEX today and bridge assets from different chains? The answer is you can, right? I mean, you can bridge your ETH to Polygon. You can do all these things. We've built it without bridges, right? So this is a layer one to layer one settlement, no bridge risk, bridge hacking risk. We're doing layer one to layer one settlement with our decentralized settlement layer.
Okay, yeah, that makes sense. Matcha has something similar to that where you can go and do your DeFi thing and set limit orders, but they don't have any limit sales. And then DYDX is somewhat similar, right? Where it's all MetaMask based or Web3 wallet based, and you're trading directly from your wallet. But I think you're still depositing assets at the exchange with DYDX, aren't you? So you're saying with Tacen, it's more like GMX where it's smart contract based. It's not like I don't need to put 1 ETH or 3 ETH into DYDX and then it's on their platform. Is there a difference? Like, I haven't used
Yeah,
DYDX
so
since the geo tag. I'm banned from using it, so I could be thinking wrong. Like, do they take custody of your assets, or is it still on the wallet? I don't recall.
I believe they don't, and I don't know the architecture too well. I do know that they have fantastic user interface design for bringing those uneducated retail investors into being able to trade more assets. But the way we do it at Tacen is you have your wallet, and imagine a smart contract as like a smart wallet, where you are still the only named private key that can do a withdraw, but there's an additional functionality of locking an asset when you want to enter that asset into an order so that you can't withdraw that asset and double spend it, right? So it's essentially um, in traditional capital markets, it's like marking something in your bank account as encumbered because it's to pay, accounts payable at the end of the month, right?
Right. And then, like, you have an order book that everyone can see, but how can I be sure that there's enough liquidity on your side, as like the market maker or the other side of that trade, that my trades will always be filled? Like, how can users know that, okay, this platform has a TVL of like, I don't know, $5 billion. And if I want to cash out 200,000 right now when Bitcoin hits 30K, that order is going to get filled. How do users have that confidence?
That's a really good question, right? Because you're thinking about it like a DEX and having liquidity pool, people staking in liquidity pools to make sure that there's enough total value locked so that you're not going to get huge slippage on price. So the difference of doing it with a central limit order book is that you actually have a real order book, right? Not an AMM approximating how price movements work when one asset gets depleted and the other one moves up. So if you see it on the exchange, it's there, right? There's actually somebody else who has an asset locked under their custody somewhere else that is going to be a counterparty to your trade. So we're not using the DEX model of having yield farmers put capital into LP pools or liquidity pools. It's actually an order book where you can have traditional market makers that you would see in well, actually any centralized crypto exchange or any other traditional asset exchange. So they make money by selling for a little bit over and buying for a little bit less, right? And they've got their spread, so they're in there providing liquidity. So when you log onto our platform and you see how deep a book is, and you say like, well, I've got $1 million worth of Bitcoin I've got to get rid of. What's the price slippage going to be on that? You can see it up front. There's no question about it. And that's one of the benefits. And that's why we've went through this painstaking process of making sure we can still have a central limit order book while keeping custody separate, because you get better price discovery, right? You're not getting into a situation where one, as a trader, price is going to move huge because there's no liquidity, or two, if you are an LP for an asset that becomes unfavorable and your 50-50 goes to like 99-1 and you're left with like 99% of an asset that's worth nothing anymore. And we all have friends, right? We all have friends who started to, dip their toe into staking and they found some obscure pair. Remember like 2 years ago, there were all of those like Ponzi economics tokens and people are like, just stake it, just stake it. I know a lot of people who lost their shirt staking it on dexes. So both traders and stakers. So Tacen, like you said in the intro, we're regulation first. We're a software company. We're trying to build good consumer products that meet the current and future regulations here in the United States. So the idea of us being able to have this central limit order book is for best price discovery. We want people to be able to trade in the way that they can trade on a retail or institutional method, but having custody the entire time, right? Custody is key, right? Well, I mean, all my Bitcoin OG friends, right? Not your keys, not your custody. That's what they'd always say to me, right? No matter what service I was using, whatever we were building, doesn't matter what it is. If you don't have control over the keys, then it's not your crypto, right? You are just a account on somebody else's ledger, and they can do whatever they want, right? And if it comes down to what is and is not possible, I'd rather be in a situation where it's impossible for somebody to take my money rather than them staying in their terms of service, right? Like, I mean, we saw the screenshots of the FTX terms of service all over Twitter in December. It said, crypto in your account is your crypto. We will not touch it. Was that true?
Far
Probably
from it.
not. I mean,
And the
we'll
same
let
with
the courts
Celsius.
decide, but we're
Yeah,
right,
Celsius
right,
was even
exactly.
more explicit with saying assets in Celsius custody belong to Celsius. And
Yeah,
users were not aware of that. I didn't lose anything in Celsius, but I get PTSD, and I have a reaction when I'm in the grocery store and I see that energy drink or it's some sort of sparkling water called Celsius. Whenever I see it, I just shudder and I'm like, oh, it reminds me of the whole Mashinsky and
yeah.
Celsius thing and how it turned out to be a Ponzi. And just like the more drip that comes out of that, the more dark and disturbing it is. And for people that lost a lot of money or everything, that's just got to be it's got to be traumatizing for them to see that drink in the store. So yeah, custody is
Yeah.
going to be paramount. Looks like you want to say
I'll give
something.
you another example, Ray. Yeah. So, we're kind of on this like this thread of like what's coming out this year, right? So we're solving custody on trading. There's other companies out there that are trying to replace the hole that was left by Celsius and Nexo and BlockFi. There's a company called Moon Mortgage. It's backed by CoinFund. So they allow you to take your crypto and put it up as collateral for a mortgage on a house or as a collateralized lending product. But they're kind of the addition to what they allow you to do is not only do you put your crypto in to essentially like get a loan on the back of it, but it's sitting in Anchorage, right? It's sitting in a uh, uh, trust license holding entity, and they allow you to trade your crypto that is sitting there as collateral, right? So this is like, we go from Celsius where, right, you literally just like take it from your wallet and you put it in their wallet and you sign a user agreement to hopefully it all works to moving that to a place where, I mean, if you don't want to custody your own asset on a hot or cold wallet and you do want to use a service that is regulated, I would suggest using something like Anchorage, right, where they do have the proper audits happening in the background. But we're already seeing the next generation of lending products come, right, after all of these kind of mysterious double digit yield products have all came back to bite people. So yeah, I mean, I think that's another thing I'm optimistic this year is transparent products, right? Transparent products that are saying, we'll give you this, you'll get a certain yield, or on a loan, you'll pay a certain rate. And these are the guardrails that are set up, right? You can withdraw your crypto or use it to trade as long as you don't fall below like a margin call level. Um, but yeah, I mean, this is just one example of a whole new generation of, I don't know, let's call them responsible DeFi products that are
Right.
coming
That's
out.
a good segue to the next topic because there's a company in Austin, Texas that also allows you to upload Bitcoin or USDC and take a loan on it for a mortgage. And I'm familiar with MoonPay. And the one thing I was wondering is like, what's the LTV on that? And with like when they lock your assets, when they're using a custody or a trust to lock your assets so that they don't have access to them, and then you don't also, there's prime trust. And like I can't say anything bad because we don't want to get sued, but Swan Bitcoin uses prime trust to custody customer assets, and they encourage all people who are DCAing or buying Bitcoin through Swan to remove them from prime trust ASAP and self custody, because self custody is their, like, it's part of their model, keep your keys and to yourself. Don't leave them anywhere, even if it's at like a regulated trust that has them. But as markets went crazy and like FTX was blowing up, Prime, was unable to process all withdrawals in a timely fashion. I don't know if they eventually were able to meet all of those. I assume they did, because if they didn't, we and all other crypto media would have eviscerated them and wrote a story about it, right? But they had
Yeah.
a hang up there, and I'm in Texas, and Swan has now kind of had to pause the DCA sort of service that they were offering. And then I know Nexo has also got a cease and desist on offering interest and custody and lending, borrowing in Texas and like other states also. So that brings me to regulation. What role should regulation play in crypto, especially with centralized exchanges and eventually in DeFi? And where are you located? Who can use Tacen? Is it a US based company? Can people that live in the States use it?
Yeah, we're US based, and the exchange is a US based exchange. We are still pre-launch. We do have our testnet open for testing right now, but Q2 will be the launch of our mainnet exchange where you can trade. Regulation. I'm for regulation as long as it brings consumer protection, right? There's a point of regulation that is kind of like a cliff. You can walk up to it, but as the point of going over the cliff is surveillance, right? Being able to track trades, like what we're seeing with China's stablecoin, being able to surveil what people are doing, use it as data collection, like that is bad, right? That is government overreach, regulation overreach. But it's obvious that we need some sort of regulation to be able to make sure that consumers are protected. One, from like an investment standpoint, right? Like an SEC style, we're out there to make sure that people who are alleging investment opportunities are good people that intend to fulfill what they say they're going to do. And two, from a money laundering perspective, right? What you don't want to have happen is for you to be matched on a DEX with somebody, and for that money to be coming from Iran or another sanctioned country, and for your assets to eventually be seized in the future for participating in laundering money, right? You don't want that as a retail investor, and you 100% cannot have that happen as a regulated institution when you talk about institutional investors coming in. So, okay, what does good regulation look like? So FTX gave us a very good example of what good regulation can look like, right? We all remember, well, maybe we don't, but I'll tell you. Sam bought Ledger X out of, I think it was Chicago, right? A crypto futures exchange that is regulated not by the SEC, but by the CFTC.
Mhm.
When they went for their license to be able to be a futures market, and I know this because I listened to the chairperson of the CFTC speak about this specifically. Um, they went through and said, like, these are all the things that you need to have to run a futures exchange, but because your asset class is more volatile, there's a few other things that we need you to have, right? So there was the classic, like, you have to take an entire year's worth of operating capital, put it in an account that you don't touch in case the exchange implodes, that you can still keep the lights on to be able to unwind any trades. But they also impose, and whether you consider this regulation or not, they said that all trades on the exchange have to be fully collateralized. That essentially means no margin trading. So it meant that in times of turmoil, that there wouldn't be this huge cascading effect of people getting wiped out for being over levered for other things going wrong in the market. So this was an example where they took the existing regulation for like a traditional assets futures exchange, added a little bit more because the asset class was known to be risky. They issued a license, right? And how did it work out? Well, if you look at the Chapter 11 filing for FTX and the web of companies underneath of it, there's an asterisk that calls out, I think it's like a handful of companies that are not filing for bankruptcy protection. One of them is LedgerX, right? And the point that the CFTC was making is that the reason that that part of the FTX empire is still alive is because they had all the checks and balances in there to make sure that regardless of if the people running it were corrupt or they engaged in corrupt business practices, that they had to prove at all points in time that there were a reduced risk in the way that they were trading, as well as a reduced risk due to a bolstering of operating capital to make sure that in the case of a high watermark of fraud in the market, that they would be able to survive. So okay, I mean that's one example of how like one regulator put one not sanction but one requirement on one company, and it worked out in the benefit. What I will say about regulation is like there are a lot of other things that can be done to protect the consumer, and a lot of it comes down to custody. I think custody, like 2023 is the year of education and the year of understanding custody fully. So I'm not sure what's going to happen. I am a part of the Blockchain Association, which is a DC-based lobbyist group that is trying to make sure that all policy being passed within the blockchain community meets the needs of the creators, right, and the needs of the consumers. I mean, most of DC is tied up with the FTX trials right now, so I'm not sure if we're going to get any new policy made. But anything that
Right.
comes through, I think, needs to be one, not focused on taxation, right, to fund other um, um, endeavors within the U.S. government, but it needs to be focused on consumer protection, right? Like my father always asked me, "Hey, I want to buy a Bitcoin." I'm like, well, one, I have to go through the whole education process for showing him how to do it, but two, I mean, until we get a lot more, until we can trust centralized exchanges, right, or educate people to get into like a hybrid exchange like what we're building at Tacen, like we're not going to see mass adoption of digital assets and crypto. And that's kind of where I want to see regulation step in, right, to make sure that like what happened with Ledger X, right, everybody was made whole, right, that was trading on Ledger X, right, there was no loss incurred. So I want to see more of that and less surveillance or blind taxation in policy.
Thanks for sharing the inner workings of that. I wasn't aware that Ledger X was basically solvent at the end of all this, so that's good to know. It sounds like simple regulation is needed. Also, when I like think of as an American, where do I do my regulated trading? Um, Outside of Coinbase, I can't really think of anywhere that I'm interacting with. So it sounds like people that got wrecked were basically in sandboxes that were unregulated, playing with products that were built outside of the US or domiciled outside of the US, and that really people in the United States should not invest in cryptocurrency until there's better products built. And those better products might come from like Fidelity and JP Morgan and Robinhood, which is seems really counterintuitive to the whole ideology of crypto and getting rid of these middlemen and these fee creators, right? But on our own, we've not created products that are robust or safe enough that would kind of become sticky enough to get people to mass adopt crypto on their own. So it's a conundrum, isn't it?
It is, and you touched on something I like talking about is the evolution of who's developing on blockchain and with cryptocurrency. And as much as we don't want to see it, like the banks are tooling up, right? Think of like who are the two traditional custodians for fixed income. It was J.P. Morgan, who got out of the business, and Bank of New York Mellon. JP, we know, has a huge crypto influence, right? They forked Ethereum and did that whole chain project, and I'm not sure what they're doing with it now. And Bank of New York Mellon has a custodian, a custody product. What does that tell you? It tells you that they're interested in building applications in the blockchain space, right? They've set the groundwork, right? With BNY Mellon having their custody solution. What's next? Well, they can build anything, right? Like we see it with Fidelity, right? Being able to add crypto to your retirement portfolio. But I think uh, when we talk about trust, right? And we talk about there being a lack of trust, right? So Tacen is an exchange. Actually, it's funny. I got my marketing hat here, right? We say trustless, right? Like don't trust anybody. But if you have to trust somebody, you should. I mean, there are a lot of parameters to trust. Like how long have they been around, right? Who else trusts them? Do you trust the people who trust them, right? When you think about how is the common investor going to get into crypto as an asset class, are they going to trust a new company that comes about, or are they going to trust a company that's been around for a couple of 100 years that they know if they have an issue with, one, it's going to remain solvent, and two, that they have a way through the legal system to have any sort of problem resolved. So I think that banks are logical developers in the Web3 ecosystem, right? And we're seeing it. I first got into crypto with digital asset holdings, which was building private blockchains for banking applications. So I know they're interested, but if you need to trust somebody, there is definitely a hierarchy when you're making a decision with your finances, right? You could think of it like picking a bank, right? When I came to America, I had to pick a bank, and I thought, well, what's important to me? And it's like, well, I want one that's big. I want the one that has branches everywhere, that's been around for a long time, and has all of the services I want. And I think people are going to think the same way about crypto, right? And when we think about new players to the space, they're kind of uncertain, and people want somebody to trust. So I think long term, these evil institutions, right? These centralized institutions might actually be able to offer a really good consumer experience and onboarding experience because they already have the relationships built with retail consumers. But the thing I will say is there's a difference between using centralized institutions to do, let's say, onboarding versus using centralized institutions for custody, right? People in the Web3 community say, like, blanket statement, centralized bad. And I don't think centralized is bad, right? Centralized is bad for custody if you're not taking responsibility for managing your own crypto. But there are a lot of things that centralized institutions can do better, right? So, I mean, I think it's, well, one, it's overcoming that stigma, and two, I don't know, empowering these institutions to be able to create better. I love that Fidelity is offering crypto in their retirement accounts. Why? If Fidelity is buying tens or hundreds of billions of dollars of crypto because they have all of these retirement accounts that want Bitcoin exposure, one, that means Fidelity as a single buyer is buying up huge amounts of crypto and basically locking it away. Like we talk about staking, this is old school staking. This is like buying up assets and putting it in a vault. What is that going to do? One, reduce the supply, price goes up. Two, it's sitting in a vault, right? They're not letting large chunks of this go. They might make a transaction once a quarter based on their investment prospectus. So it's going to reduce volatility as well. So institutions creating products for retail investors, I think, is net good because institutions getting like long-term like retirement funds getting into this makes crypto better for all of us, right, in terms of volatility and price. But yeah, I mean, we could talk about this for hours, but I think it's net good. But people have to remember there's a difference between centralized institutions offering products and centralized institutions taking custody of assets. The latter is the bad one.
That makes perfect sense. And I agree, we could talk about it for hours. We're actually running down the clock here. So before we wrap up, I'd say the next time we have you on show, I'd like to talk more um, about reducing Bitcoin's volatility through institutional investment. I like the volatility in crypto. It's good if you're a trader or a swing trader, like volatility is great, high
and that's
returns,
and that's why
high
you need
returns.
Tacit, right? You need it to keep your asset in the exchange under your own custody so that you can take advantage of volatility, right? Yeah.
Exactly. But then on the flip side, like as someone who's really into Bitcoin and doesn't want to part ways with it, um, I am looking for more utility from the asset. It's not just about medium of exchange, store of value from me. Like I like to have things that have equity potential that can be unlocked, like my house, or a collectible car, or art, or Ethereum now has that kind of like utility through liquid staking derivatives, and that it's an interest bearing asset. So I'm looking for that from Bitcoin. And if that means muted volatility so that it can have a price floor that's like within the $30 or $60 range, and it's going to hold it, and then I can start to collateralize this asset, or build off of its value without parting ways with it, then that's also interesting to me. So I want to talk about that more in our next show. We can talk about, should Fidelity absorb Grayscale if possible, like that 600K Bitcoin that's out there? Should they absorb it and then repackage that widow making trade product, which I think that would be good. Either them or JP Morgan are probably eventually going to do that. And then I also know that you build protocols and help like projects. So I wanted to talk to you in future about, like, let's say I have 50 or $100,000 or $1,000,000. I have a great idea. I want to launch an NFT project. I want to launch a DeFi project that has a token, but I have no experience in crypto. So, but a background in finance maybe. So I know that you work with like projects doing kind of like white label. Here's how you launch a
Yep.
token.
Like
Here's
an
everything you need to
incubator.
do.
Incubator.
Yeah, an incubator. So I want to talk about that next time. But in parting, the most impacting thing that you said that has stuck with me through this is that this is the year of reformation. And of course, custody is super important, but this is the year of reformation. So before we sign off, if you could say anything to anyone who's listening right now regarding crypto and just what's in your mind, what would that be?
I would say make sure your crypto is in your wallets. Make sure that you have physical touch over your crypto and that it's not arm's length away sitting on an exchange somewhere. And if you don't know how to do that, research how to do that. One, because you're going to protect yourself, and two, because that's the future. Educating people on how to pull stuff off exchanges and put it in something that they have control over.
Hmm. Do you think eventually there will be a like DApp built that I just log into my ledger, click withdrawal, and to what account it goes to, just like your Bank of America app, and it does all that stuff in the background for you?
Um, Possibly. I mean, it would require API access to all the centralized exchanges for it to be able
Really
to start
dangerous.
pulling stuff off. Yeah. Um, yeah, I think the future is using the Coinbases of the world as on ramps, and then using all the awesome stuff that's being developed um, out there. I think we do have to get off of um, browser-based extension wallets. I think that's a point of confusion for a lot of users that are coming into the space. We mentioned DYDX a couple of times. I would call them the gold standard right now of how to take like a web application and then explain to people how to use like the extension wallet. But it is still very confusing because people don't understand what's happening in the background. And mobile apps, I think, are a bit better in the sense that everyone gets what a mobile app is. Everyone has Venmo. They know how to send money. So to do like a mobile based like spot trading application or to start doing like more DeFi work there, I think it's easier to get people to understand it. But um, yeah, I mean maybe we can build a DApp. How about you
Yeah.
submit a proposal to the incubator and we get you some funding?
All right. Yeah, sounds good. Well, man, it's been a pleasure, bud. It's good having you on. You're deeply knowledgeable. If people want to hear more from you and follow you and just learn about what you're building and your thoughts on what's happening in the crypto space, where can they find you?
Yeah, Twitter. My handle is 0xbud. Um, LinkedIn, the search Bud White. I post equally on LinkedIn and Twitter. Um, and then, yeah, I mean, I do opinion pieces every once in a while. I think I have one on Cointelegraph coming out next week that kind of dives a bit deeper into like this idea of custody and owning your assets and the history of it as it pertains to like dollars in the bank account, like your childhood bank account. So yeah, give me a follow. I say interesting things every once in a while. So
All right. Well, man, it's been a pleasure. Thank you for coming on. I'm Ray Salmond, host of Market Talks. We're here every Thursday at 12 ET. So subscribe to the show. We always have really interesting guests, and I'll see everyone next time.